Hi everyone, Gavin Lennox here. Welcome to this webinar we're running this afternoon. I'm the CEO of the Icehouse, and I'd like to introduce two other panelists, waiting for one hopefully to join us as well. Joining me here for this conversation this afternoon is David Irving. David may be known to a number of you. David was the founder of the Icehouse, is current chairman of the ICE Foundation, and has been a small, medium-sized business advocate for many years. So welcome, David. Also joining me is Lincoln Sharp from Campbell Tyson, one of our alumni companies. Lincoln is an experienced accountant and will be able to answer a number of accounting-related questions. The third panelist we hope will be joining us soon is Karna from the BNZ. He's the General Manager of Growth and Performance for Partnership Banking for New Zealand, and hopefully he'll be joining us in the near future. So let me just give a few pointers about how today's going to run. It'll be on mute in terms of you, the audience, but please submit any questions at any time through the Q&A section you'll see at the bottom of your screen. You can also interact with people who are managing this webinar through the chat channel, which is another button at the bottom of the screen. I'd like to thank the Regional Business Partner Program and ATEED for their support with all of our webinars, including the one today. And at the end of the webinar, there'll be a button for you to press if you'd like to provide any feedback. But hopefully this is an open session in which we can answer some of your questions. Particularly, there's a lot of help and available today with relating to COVID-19. But we'd like to focus today on one aspect of the help offered to small, medium businesses. And those are the two schemes to help with liquidity for small, medium businesses. These are the previously announced business finance guarantee scheme. That was about 3 weeks ago that was announced. And the more recently announced, in fact, went live yesterday, the small business cash flow loan scheme. So let's start with the description of both of those schemes. Let's start with the small business cash flow loan scheme, which went live yesterday. Lincoln, I wonder if you could give an outline of how that works.
Certainly. The cash flow loan scheme was brought about in part due to the poor uptake of the previous arrangement that the government had decided upon. And what they wanted to do was to try and get cash into the hands of businesses as quickly as possible. So the parameters of the actual cash flow loan, as you said there, Gavin, they became available yesterday, and it's going to continue to be available until the 12th of June. Now, the businesses that are able to avail themselves of that, if they've already made a claim under the wage subsidy scheme, then they've ticked primarily all of the boxes there, because there's a lot of similarities in terms of qualification between the two schemes. So they've got to be a registered operating business in New Zealand. They've got to have staff or employees gainfully employed, and with an aim to retaining them. There's fundamentally a requirement to either predict or have incurred a drop in revenue, and that's revenue, turnover, not profit, of 30%. And they're basically stipulating a 4-week period for comparing that to prior years. It's a floating period between January and I think, again, a date in June. So there's quite a wide time frame to actually qualify for that. There has to be evidence, or the business needs to be able to present evidence that there's been an effort to continue the business by tapping into other sources, be that bank support or supplier arrangements, and there has to be a plan in place that keeps the business viable. Now, this particular cash flow loan scheme is aimed at your SMEs. It's 50 employees or less. So that's how, if you have 50 full-time employees, the maximum cash loan can be drawn down of $100,000. So it's calculated at $10,000 for the organisation and $1,800 for each of those employees. Now, the business has to be in a position to be able to continue to operate and be viable for an 18-month period, that is able to pay its bills as they fall due. And there needs to be some sort of plan in place that contemplates how that's going to happen. Now, the application, sorry?
I was just going to say, one of the questions I know that some small businesses have is, what is the definition of viable? How would they communicate back to the IRD their viability?
Because we're steering essentially into the future for 18 months, it's a very tricky box to tick. And the best way that a business can have evidence of that is to have some sort of projection in terms of how they expect their costs to fall due, because it's really the business, for it to be viable, needs to be able to meet its debts as they fall due over the next 18 months. And the best way to provide evidence of that would be to have a budget or cash flow plan for that period. And a lot of people find them quite difficult, and particularly in times like this where income is uncertain. So really, it does require the business to contemplate how it's going to operate under level 2, under the level 2 arrangements, how it's going to be able to generate that turnover, what other sources of income it's going to be able to generate, and measure that against the costs that it knows it's going to have to incur.
So really, they'll need at least a basic cash flow plan, a revenue plan and forecast, and some sort of idea of what a risk profile would be based on the future, what business they're in. Correct. And probably some financial advice from their accountant.
Oh, thanks for the plug. Absolutely. I think getting an accountant on board is helpful, particularly when dealing with the inland revenue, and it is the IRD who are going to be administrating this loan scheme. And it is a loan, it's not a gift. There's those funds can be repaid within a 12-month period without any interest costs. But if you don't repay it within that 12-month period, there will be a 3% interest charge, and there'll be a requirement to pay it off over over a 5-year period, so over 60 months.
One of the questions that's come in, and I think it's relevant to just answer it now, is how does the scheme differentiate between part-time and full-time employees?
Right, so the wording, as far as I'm aware, relates to full-time employees, and that is employees of more than 20 hours a week or more.
I'll just correct you on that, only because I listened into the IRD present an hour or so ago, and they emphasise that it's full-time equivalents. So what that means is you can, as long as you're under 50 full-time equivalents, you would be able to apply for this loan. So that means you can apply, multiple part-time people, but obviously up to a maximum of 50 FTEs.
Yes.
And it is important that this particular scheme is run directly with the IRD. So there's no involvement of banks or accounting firms. It's directly applied for through the My IRD website, and we can send a link to the IRD website as part of this, Elena, during the end. I think one of the other questions that came through was relating to what the loan could be applied to, what type of expenses. Can you give an idea on that?
My understanding is that there's an element of flexibility, but the loan is there to provide immediate cash flow for the day-to-day operations of the business. So it's not there to provide a drawdown facility for the owner. It's there to ensure the continuity of the business, so would best be applied to ongoing expenditure.
Yeah, I think that was emphasised again by the folk from the IRD. It can't be used to pay down debt or pay off taxes. It's not an advance for shareholders. It's truly supposed to be applied to operating expenses like supply chain, rent, utilities, insurance. But I think things like paying for business development would probably be a grey area, but fall into that bucket as well. There's a bunch of questions relating to this that I'll cover perhaps afterwards, but maybe we could move to the other scheme and get some clarity. Welcome, Karna, for joining us. Glad to see you there. You're on mute, by the way. I'd like to introduce Karna, the General Manager for Growth and Performance at BNZ, and it's good having Karna here as a representative, not just of the BNZ, of the banking industry. And the other scheme that the government has offered for small businesses is this Business Finance Guarantee Scheme. This has a different profile and structure in terms of how it's administered and the quantities and criteria. I wonder if you could just outline that for the audience, Karna.
Yeah, sure. Thanks, Gavin. Look, my apologies for for being a little bit late to this meeting. I think the scheme itself has had quite a few changes and iterations over the last number of weeks, in the want of the government and the banks trying to get out and get together to try and provide a facility. There's been a number of iterations that have gone through, whether it be the Treasury, the banks, the New Zealand Banking Association, the government themselves. So where we're at today, from the 1st of May, the Finance Minister really confirmed a few changes to the business finance loan scheme, effective from essentially the 15th of May. The first one was a removal of the threshold for 250,000 turnover, lowering the turnover revenue threshold, which means that it's now available for businesses who are turning over from 0 up to 80 million. I think the second one was the removal of the exclusions on dairy, sheep and beef farming. And this now, in effect, allows the agri-based customers to come through and start to have their applications considered as well. Excuse me. There's a change of date in which customers also must not be on the bank's watch list. So that was changed from previously the 28th of February back to the 31st of January 2020. And that effectively gives customers a chance to work through what their operating business was like pre sort of back end of last year, heading into the start of the new year, and then have a look at how they were operating and consider that on an ongoing basis going forward for any finance capability. The next one was really around the extension of temporary facilities that had been refinanced or can be refinanced into the BFS scheme up to 180 days. Previously, that was 90-day threshold, and now that's been moved to 180 days. There's been some conversations around relaxing some of the requirements in terms of banking conditions. So one of those is certainly around customers not needing to draw down existing committed facilities. But so long as they remain in place, not needing to draw those, you could also then look to work through BFS first. And then there was the removal of the government's requirement for banks to obtain a general security agreement from customers for lending greater than 50,000. Now, obviously, those changes are useful for people, but I will stress to say that whilst they're good changes to help us try and access and provide information and funding through schemes to our customers, there are still prudential lending standards and obligations that the banks are held by. None of that has been released. So where you have your normal standard credit policy that applies, they may be looking to apply for what they call potentially credit policy exceptions to the rule around the scheme. So I know banks and the New Zealand Banking Association are trying to come to terms with how that actually gets played out in terms of what happens there.
Mm. So thanks, Karna. So clearly this scheme has been around a little bit longer than the one announced yesterday, but it also a little more complexity. My understanding at high level, the maximum amount that a business can apply for under this scheme is $500,000, and that of that, 80% is sort of backed by the government and 20% by the bank in terms of risk. However, the banks are the entity with which the small businesses must apply, and all the banks are essentially administering that based upon the criteria deemed by the government. But what would you recommend a small business do if they wish to try and apply for that type of credit, that kind of loan?
Yeah, thanks, Gavin. I think there's a couple of things in that that people are looking at understanding. And the first one is they're looking at a government backing and 80% and essentially underwriting some of that funding that may be used as a loan. So what I would say to that first off is, if you think about it, the government is wanting to provide and help provide that facility, but they also have some conditions behind a quasi-lender type scenario with the bank, if you think about it, because they have an expectation of that to be paid back as well. So try and think about it in that term. What should you do as a business? If you have gone through your bank or any bank's inquiry application process, I would encourage you to make sure that the first things you've done is you've had a look at restructuring your cash flow on your fixed and variable costs and making sure you know what you're doing now and what you're going to look like in terms of trading out. Now, this includes where you've made new revenue and maybe you've looked at some adjacencies around flipping to digital very quickly and still earning income. You know, if you're a gym and you've been affected because you can't have patrons utilizing your gym, that doesn't mean you can't then go forward and have online Zoom sessions and run fitness classes and still charge, etc., etc. So banks are going to be looking for those sorts of things and working with you on that basis in terms of what you're managing on your cost base. What else you need to do is I would make sure as you're talking to your advisors, connect them together with your bank to have a really good, deep, interrogative conversation about how, one, you need support, what support you actually need, what you think you want to apply it to, and how your advisor and your bank can actually help you and what options are indeed available. That's the best place to start. Have a draft of a business plan, have your cash flow forecast ready, and then start to interrogate that on an ongoing basis, not just a one-off.
Yep. So what I hear from here, I hear the larger loan scheme administered through banks are a more traditional and more complex process for small businesses to engage in, but ones in which you should engage your advisor as well as your bank to try and navigate through. But let me ask David a question here. You know, some recent research at a high level from ATED, I think, indicated that only about 2% of Auckland businesses have taken up the business finance guarantee scheme. Have you got any views from an SME perspective, David, as why you think that might be the case?
Yes, I have. I mean, it's a real anomaly, isn't it? That here is a need, apparently, 6.2 billion fund set up, and we're sitting with about 30 million dollars that's been lent. So clearly, on the face of it, it's not proving itself valuable, or there's something going on in the process. And in my sort of inquiries, I've learned that there are many you might call people who are coming forward who haven't got current facilities, and so they're not used to the sort of sophistication which Karna quite rightly points out are required for these sort of things. And they won't think of things like personal guarantees, that some of those things would be very new to them. So I'm hearing people having trouble with the length of time things are taking for them. But so people come forward for the system, they find it too sophisticated, and they walk away because it's just too much for them. So a hairdresser or a small retailer on a back street wants some support, but they're just not used to it. So it's a real problem. Now the bank, on the other hand, in the way what they're dealing with, they will look at this, and if someone's got existing facilities, they'll find actually that the normal facilities they've got, ironically, are exactly the arrangement that might service the needs of that person coming in. So if they've got facilities, the bank will use those facilities almost with more flexibility than the scheme is providing. When I look at what the bank is working with here, and you heard someone, I think Lincoln said 40 iterations. So the amount of change that's going on, the securities arrangements, even now on the 15th of May, there's some change going on there that Karna referred to. The fact that these arrangements are unusual for a bank because they're in a pandemic. They are dealing with putting something right rather than, if you like, enabling growth, which is what the normal type of funding would be for. The models that the bank has got for growth don't necessarily fit very easily in their credit criteria and analysis for putting something right. To be fair to the bank, there's staffing. It could be a stretch. You've got a SME manager who's got 1,000 clients, and then he gets a number of these sorts of different circumstances to deal with.
So there sounds like quite a wide range of potential barriers for the larger scheme. It would be great actually if anyone on the call has tried to apply for this scheme and perhaps could give a one or two liner about how it's gone. One thing I did anecdotally hear this morning from the smaller loan scheme, which is the direct government loan scheme. We had one of our alumni who came through and said that they were able to apply for the loan and get a response within a day, or even less, in fact. So it appears that the smaller sum loan, the small business cash flow loan scheme, appears to be simpler to apply for, and maybe more applicable to the small sole owner type zone operator businesses or very small businesses. But if a larger sum is required, it definitely requires a conversation with the bank, who will then help navigate through the changing regulations that the government's put in place. If you were to go back to the government, David, what were the one or two things you'd say to them that they should consider improving to make life easier for small, medium businesses?
Well, I think actually you're asking a bank who's doing its normal business to make quite a change with what they're being expected to do, and in a circumstance where things are changing a lot, the requirements on them are changing a lot, and they have responsibilities to their shareholders and their depositors. Now, I'm not here representing the bank, but I do think that in representing the owner manager, that there ought to be a simpler process for this, and maybe we've got this system in the wrong house. Maybe the house it should be in is a COVID new government agency that's set up solely for the purpose of administering this service and function. And I mean, the idea of doing it for the smaller arrangements, that may be, because as you rightly say, they're simpler. These are more complex. But in our past, we've had development finance corporations, that were set up in the 80s to assist the government with its funding of growth. Well, here we've got a real pandemic, something that's much more serious and more immediate. And I think, to be fair, we need to potentially look at what's the right place for this to be undertaken. And I'm not qualified to talk to that, but I am qualified to say, as an SME advocate, it needs to be better than what it is.
Okay, thank you, David. Maybe it's time just to take a couple of questions from the audience, just relating to some of the information we provided. So, one question came in here: are they able to apply the cash flow loan scheme with current staffing levels? But what will happen if the levels are likely to drop in the upcoming period? Perhaps Lincoln, you could answer the small business cash flow loan.
My understanding would be that much similar to the wage subsidy scheme, the intent was to retain staff. And I do know of some organisations that have had reductions in staff after they've received the wage subsidy, and that could be for a number of reasons. So long as it doesn't relate to them being made redundant by the employer, ordinarily they've been able to keep the funds and instructed to utilise it with other staff. So my understanding for the cash flow loan scheme is similar, that it's based on a point in time when you make the application, and then subject to review as circumstances change.
Yeah, and it probably links back to your viability point as well, where you've got, if you're forecasting reductions in staff, then that would be part of your viability plan going forward, and that would be part of the process of approval.
Yes.
Another question was, can the loan be applied to marketing costs? Do you have a view on that? Maybe Karna as well. Are those type of application of funds constrained to just operating costs that are very basic? Karna, maybe you've got a view.
Yeah, certainly on the BFS perspective, it is around your operating costs. It can't be used to pay, obviously, shareholder dividends and drawings and the like. But I know that further discussion with Treasury and those things are saying, like, in normal operating conditions, that you would utilise those costs to do so. Then, so long as you work through that process, then if they're normal operating costs that you would look to supply,
And marketing would be seen as an operating cost, right?
Yeah, it's seen as operating cost, correct.
Okay. One of the questions from the audience was, what are the penalties if the loan has failed to be paid back within the 5-year period? Do you have a view on that, Lincoln?
I think this is possibly part of the rationale for the government utilising the IRD to administrate the scheme, because no one's quite as good at recovering money as what the IRD are. That said, they've made made it very clear that if the loan is provided, nothing can be deducted from it if you have taxes outstanding. So the IRD have effectively ring-fenced this loan as a separate function under them. So in terms of penalties and interests, I'm not entirely clear, but if it coincides with the IRD's normal approach to penalties and interest, then you're looking at an interest rate of over 8% and penalties accumulating each month.
Okay. Last question here is more of a looking back, looking into the future one. It's around the interest rates, and Karna, you might have a view on this. The question here is, at the moment, the interest rates are extremely low, and it's a good time to borrow, but they're concerned about what the next 3 to 5 years will bring in terms of interest rates. Since the government's offering help, how will they recoup these funds, and how will it affect the interest rates in the long term? I'm a little confused about the question, but perhaps you can, maybe my understanding is the interest rates will be locked in at the time at the low rates, interest free for the small business cash flow loan for the first 12 months and then incurring 3% after that. What are the rates that would be locked in on the business finance guarantee scheme, Karna?
So the rates that are locked in on the guarantee scheme, obviously each bank has got to work through that, but they vary. So I don't think you'll get anything over 3%. I think everyone's sort of between the 2 to 3%. Some may be less than that. So a range would be between I'd say 1.8 to 3%. I think is where the rates will look to go. And I think for the scheme itself, it's across obviously the 3-year period with the ability to change that at the 3-year period. So don't forget that if you take the scheme, the loan scheme, there is a payback period. So you can have interest-free period for 12 months, but then it must amortise on the full payback over the next 2 years. And if it doesn't, then there is an opportunity to work with the bank to move that into another type of facility. So I think that's something we've advocated for as banks, to say that the 3-year time frame is too small. We're really positive that we've seen it in the smaller end out to 5 years, and we would be looking to do the same thing around that, because it's tough for businesses if they're using money going back into operating cash flow and they keep going. It might take them 2, 3, 4 years to actually work through that, and you don't want to drag on having high repayments coming through. So that's the range that I see. I know on a BNZ perspective, we are 2.5%, and so we're working through that with our customers as they come through. So that's where we are.
So really the rates on the business finance guarantee scheme are negotiated with the bank, but you've given an indication of what the BNZ offer. And with regard to the small business cash flow loan, it's interest-free for a year and 3% for more than that. A couple more questions coming in. One question was asked about, again, the application of the loans. We talked about core operating expenses. Does that extend to fixed assets as well, in terms of capital equipment purchase that will effectively drive the business in the future?
So there's conditions upon capital expenditure use, and that's a limited amount up to 5%. So obviously, you want to make sure that the money's going to productionising and operationalising the business. So there is a small percentage use there that you can utilise for CapEx. But I think government doesn't want to see people taking $500,000 and putting it all into CapEx and development work, right? I think they wanted to get it to reboot businesses.
Okay, good. That's a good intent. One question here around the criteria. So I know that the wage subsidy scheme and this cash flow loan scheme require the business owner to declare that there will be a 30% reduction in revenues. The question really is, what if it turns out to be slightly less than that? Is there an obligation for the owner to pay back a percentage of the loan, or is the sum of the loan How would that work? Maybe Lincoln, you've got a view.
My understanding is that, well, the criteria are that you can prove or have predicted that turnover will drop. So there is some leeway there. You won't be penalised if you, with good justification, thought that your turnover was going to drop by 30% or more. However, there is an obligation to pay it back if you don't. If you can't prove after the fact, once it becomes clear that you won't result in a 30% drop in turnover, there is that obligation to repay.
Okay. Is that your view as well, Campbell?
Yes.
Okay. Another question here, in terms of the revenue reduction required, will the IRD be looking at your GST filings as an indicator?
Absolutely, they'll use any tools available, but again, it will more be what they'll use to send up a flag for further investigation, as opposed to absolute proof that you weren't entitled to the subsidy or the cash flow loan.
Right. Okay. I think this question's been answered before, but one of the questions here was just to reiterate, what is the value that can be applied for, the maximum value for the two schemes that have been applied? Lincoln, I think on the small business cash flow loan, can you just confirm that?
It's $100,000, and that would be for a SME with 50 full-time equivalents as employees. So that's based on $10,000 for the organisation and $1,800 for each full-time employee.
Okay. And on the business finance guarantee scheme, Karna?
Yep, it's up to $500,000. So obviously, depending on the size of the business and the considerations, that's what that is.
Good. Well, look, I think that answers most of the questions that have come through. We at the Icehouse are very keen to not only continue the dialogue about this, but other matters. We have a resource page on our home site. We also would love to hear from you and I'm sure David is, as a representative of the ICE Foundation and small businesses, we'd be very interested to hear of your experiences of working with either of these schemes, both positive and negative. And there's an easy way to provide feedback through our website or through your contacts there. But in summary, the small business cash flow scheme, simpler to access directly through the IRD site, but for smaller sums. The business finance guarantee scheme, more complex, larger sums up to $500,000 and administered through your bank. David, is there anything else you wanted to add from a high-level perspective of liquidity of companies, small businesses, and guidance you may be able to provide them?
Yes, there is. I mean, just in brief, on the scheme itself, I've always been concerned about personal guarantees being asked of parties borrowing money. Seems to me you should rely on the assets and liabilities and cash flow in the business. But we've got very used to banks taking out mortgages or encouraging mortgages as a form of extra security. That will serve their security needs. But in a time when it's a coronavirus-driven circumstance, I just find myself thinking, well, they've got an 80% guarantee from the government. Why should a person's personal assets be up for grabs when it's a cause well beyond their own circumstance that they could have controlled? They were banned in the UK. I think they ought to be banned here. And the bank rely on the cash flows and the assets that are in the business. If I broaden my point out to I think what you're alluding to, what else is there? I think companies that are in distress, there are a couple of areas to look at. One is the new debt hibernation arrangement that's being made available. That gives people 6 months to really get their house in order, bring in perhaps new equity, reorganize things with stakeholders, put proper cost-saving processes in place to secure the debt that then when it does come out of hibernation, it's in a proper, securely looked after condition. I also led my process of Section 14, and I'm not sure which act I'm talking of here, but it's a compromise arrangements that can be made for companies in distress which leaves the business in the control of the owners, so they don't lose the control of the creditors arrangement. It's actually in their control what they make undertakings. Again, it's for a period that they will get that opportunity for. If I broaden it a little further, and I might say to my owner-manager colleagues, I think that we've seen some changes, release from obligations of the RMA Act. That is for a 2-year period. That means that people are going to have more freedom from the penalties than the constraints of an RMA Act. I think the same thing should happen in competition law. The Commerce Commission should relax the conditions on owner-managers and the way they could talk with their competitors about better arrangements, the way we could structure things in a marketplace that would be the benefit of both parties and the consumer not lose out. And finally, I'd say I think with all the digital applications that are potentially now going to be needed by businesses to keep themselves up to date with their running of their companies, I'd say we ought to be looking at grants or some form of easy, again, loan that is specific to that requirement that will enable companies and give them more flexibility with their futures with digital applications.
Well,
those are the sorts of things.
A lot to think about there. Thanks, David. And I think we as the Icehouse be happy to hear from our key constituents, the small medium business owners, and help aggregate some of that feedback and be one of the voices back to government to help guide policy and direction.